Hello and welcome back to the Research Analyst series of NISM. So we were covering the topics. Our next topic is institutional participants. So let's start. An investor is the backbone of the securities market in any economy, as the one leading surplus resources to companies for their productive activities. Investors in securities market can be broadly classified into retail investors and institutional investors. Institutional investors comprise domestic financial institutions, banks, insurance companies, mutual funds, and foreign portfolio investors. Some of them are defined here in brief. First one is foreign portfolio investor or FPIs. A foreign portfolio investor (FPI) is an entity established or incorporated outside India that proposes to make investment in India. These international investors must register with the regulator, Securities and Exchange Board of India or SEBI, to participate in the Indian securities market. P-note participants. Participatory notes, P-notes or PNs are instruments issued by SEBI-registered foreign portfolio investors to overseas investors who wish to invest in the Indian stock markets without registering themselves with the market regulator, Securities and Exchange Board of India. P-notes provide access to Indian securities to these investors. Next one is mutual funds. So what is the definition of mutual funds? A mutual fund is a professionally managed collective investment scheme that pools money from many investors to purchase securities on their behalf. Mutual fund companies invest the pooled money in stocks, bonds, and other securities depending upon the investment objective of the scheme, which is stated upfront. A fund manager with the help of research team takes all the major decisions in terms of which companies to invest in, the percentage of each stock in the portfolio, when to exit, and so on. Each investor owns units which represent a portion of the holdings of the fund. Diversification of investments is an important aspect of mutual fund investing. It helps in reducing the risk in investment for the investor. As a result, the investor is less likely to lose money on all the investments at the same time. Insurance companies. Insurance companies are core businesses to insure assets. Depending on the type of assets that are insured, there are various insurance companies like life insurance and general insurance, etc. These companies have huge corpus and they are one of the most important investors in the Indian economy by investing in equity investments, government securities, and other bonds. Like mutual funds, each insurance company also has designated people who are responsible for investment decisions. Next definition is pension funds. So, a fund established to facilitate and organize the investment of the retirement funds contributed by the employees and employers, or even only the employees in some cases. The pension fund is a common asset pool meant to generate stable growth over the long term and provides a retirement income for the employees. Pension funds are commonly run by the financial intermediary for the company and its employees. Although some larger corporations operate their pension funds in-house, pension funds control relatively large amount of capital and are some of the largest institutional investors. Next topic is venture capital funds. A venture capital fund refers to a pooled investment vehicle like mutual fund, but with mandate to invest money in enterprises that are in the early stage of the development, but with the potential for of long-term growth. The longer gestation period and higher risk of failure make it difficult for such companies to access conventional sources of finance such as banks and the capital markets. Venture capitalists bring managerial and technical expertise as well along with capital to their investee companies. Next definition we have is private equity firms. Private equity is a term used to define funding available to companies in the early stages of growth, expansion, or buyouts. Investee companies may be privately held or publicly traded companies. The term private equity includes venture capital firms. The money in the fund is contributed by investors called limited partners, and invested and managed by the general partners. Some of the private equity funds are specialized funds with competence in a particular industry, stage of the company, or targeted deals such as funding buyouts. Hedge funds. A hedge fund is an investment vehicle that pools capital from a number of investors and invests that across the assets, across the product, and across the geographies. These fund managers generally have a very wide mandate to generate return on the invested capital. They hunt for opportunities to make money for their investors wherever possible. In that sense, actually term hedge fund is misnomer as these funds may not necessarily be hedged. Alternative investment funds. These are privately pooled investment schemes that invest in various asset classes such as real estate, private companies, commodities, and such other alternative investment assets. The term alternative typically include all other assets, including listed equities, fixed income instruments, fixed deposits, or collective investment scheme or investment platforms such as mutual funds, NPS insurance plan that invest in these assets. In India, alternative investment funds (AIFs) are defined in the Regulation 21B of Securities and Exchange Board of India. Alternative investment funds regulations 2012, it refers to any privately pooled investment fund, whether from Indian or foreign sources, in the form of a trust or a company or a body corporate or a limited liability partnership, that is LLP, which are not presently covered by any regulation of SEBI governing fund management, like regulations governing mutual fund or collective instrument investment schemes, nor coming under the direct regulation of any other sectoral regulators in India like IRDAI, PFRDA, and RBI, etc. SEBI categorizes AIFs in these three categories. First category is Category 1 AIF. These refer to AIFs which invest in startup or early stage ventures or social ventures or SMEs or infrastructure or other sectors or areas which the government or regulators consider as socially or economically desirable. These include venture capital funds, include angel funds, SME funds, social venture funds, infrastructure funds, etc. Category 3 AIF. These refer to those that use complex investment strategies, including use of leverage and derivatives. Hedge funds, PIP, pipe funds, etc., are registered as Category 3 AIFs. Category 2 AIFs. AIFs which do not fall in Category 1 and 3 and which do not undertake leverage or borrowing other than to meet day-to-day operational requirements are categorized under Category 2 AIFs. Various types of funds such as real estate funds, private equity funds, funds for distressed assets, etc. are registered as Category 2 AIFs. Investment advisors. Investment advisors work with investors to help them decide on asset allocation and make a choice of investments based on an assessment of their needs, time horizon, return expectation, and ability to bear risk. Uh, they may also be involved in creating financial plans for investors, where they help investors define their financial goals and propose appropriate savings and investment strategies to meet these goals. First one is EPF. So EPF is a scheme that is used to provide retirement benefits in the form of defined benefit schemes to employees of covered organization. Every employer is obligated to provide 12% of basic salary as contribution to the scheme, and equal amount is deducted from the employee's salary. These the funds are deposited with Employees Provident Fund Organization, that is EPFO, which administers and manages the funds. The fund pays predetermined rate of interest decided yearly to the beneficiaries. The fund invests in debt instruments and equity instruments, but employees do not have any say in the investments or asset allocation to the fund. Second one is National Pension Scheme or NPS. This is a government-sponsored retirement scheme. Subscribers contribute regularly to the scheme and on maturity The funds accumulated in the scheme can be used to buy annuity products. Subscribers will also have the option to partially withdraw the funds at maturity. Corporate NPS schemes can be offered by employers in addition to other retirement benefit schemes. NPS offers various choices of funds, and beneficiaries can route it through to the fund of their choice. Family offices. Family office refers to an organization that handles the wealth of a wealthy family. They uh, typically take care of all aspects of financial management of the family, including investments, estate planning, and tax planning. They also take care of other activities such as day-to-day accounting of families' income and expenses and handling payments to vendors, household staff, etc. There are single family offices and there are multi-family offices. Multi-family offices handle the finances for multiple families. Last definition we have is corporate treasuries. So companies and other business organizations may have surplus funds which they intend to use for potential future opportunities or to meet future obligations. The organizations would gain if these funds are temporarily invested rather than to let it be idle in their bank's current accounts. Large corporates have a separate treasury team that handles such investment of surplus funds. In case of other businesses such as private limited companies or partnership firms, these activities may be handled by the regular finance team. Corporate treasuries, on account of their larger sizes, get opportunities to investment in many different types of securities. Smaller businesses, however, however, mostly park their funds through mutual fund. Next topic we have is retail participants, and we will cover this topic in the next video. That's it for now. Thank you.